Our housing markets are still in good shape despite the lockdowns, and in today's Property Insider video, Dr. Andrew Wilson gives us his latest data, including the housing price figures for the end of the month of August. And overall, we've done pretty well, other than one state. We'll tell you where that is. We'll also talk about the number of properties being listed for sale compared to those being sold, so you've got an indication of what's ahead, plus a deep dive into quite a lot of property data. So if you want to keep up to date with what's happening in our property markets, please subscribe to our YouTube channel and click the little bell icon so we keep you updated every time a new show comes out. We're in unfamiliar territory. A lot remains unknown about what life's going to look like on the other side of our lockdowns. This time round, it looks like we're not going to exist in a COVID-0 world, so we don't really know what that means. How will households spend? Are people going to return to work, to the main offices? What's mobility going to be like? Basically, we're in uncharted waters. Yet despite what's now more than 9 weeks lockdown in Sydney, and most likely a few more months to go, and Melbourne in lockdown, I think number 6, and in fact half of Australia in lockdown, our real estate markets are still in good shape. Look, of course there's concerns that as the restrictions drag on, they're only going to weigh down our housing markets and households' financial situations. But so far, there are very few signs of housing distress, especially when you compare them with a year ago when we had the lockdowns. Loan deferrals are at a fraction of the first lockdown. Property discounting is minimal compared to this time last year, but so far there are very few signs of housing distress. Compared to last year, loan deferrals are at a fraction of the first lockdown. Remember last year there was property price discounting, it's minimal at the moment, and there are a relatively low number of distress sales. In fact, property values are rising in all our capital cities in August. There seems to be a recognition that lockdown isn't going to go on forever, that once the vaccination rate gets past a critical number, our economy will reopen. Last year, it was different. Many households took out deferred loans. They preemptively used them as an insurance policy. And of course, fortunately, they didn't seem to need them. In fact, as we entered these lockdowns, many households had stronger balance sheets and our housing markets were at an all-time high. There also seems to be less fear around losing jobs and greater confidence that house prices are going to be resilient. And on balance, our property markets are holding up much better than they did last year. But clearly we're going to have to watch and see how it all plays out over the next couple of months. So in this week's Property Insider chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, I'd like to discuss how our markets are holding up, what's ahead, and what's really happening. Hello, Andrew.
Yes, hello, Michael, and a very, as usual, precise and comprehensive, if you can have those two together, introduction. So, yes, it is the end of the month.
The end of the month, so we've got some figures, and before we go into the affordability figures, the listing figures, the sales figures, because you've got some great data for us, this week the auction results really were a tale of two cities.
You know, when we look at the headline numbers, and we start with Melbourne perhaps, and we did get a steep fall in the clearance rate under 50%. We've probably been expecting that, but really looking more closely at the figures, there was over 60% of reported properties were withdrawn from auction. And of course, withdrawals are counted as part of the mix, and they're not really a passed in, but per se they are regarded as a passed in as a proportion. So that's why clearance rates fell. But interestingly enough, Michael, of the 277 properties reported as going under the hammer on Saturday in Melbourne, 200 were sold. So there was only 7 passed in. So you can see there that the market still has a strong appetite for property. The buyers are still quite happy to transact, but it's just that the listings reflect decisions that were made prior to shutdown. So people are obviously withdrawing and waiting till there's some more clear air. And Melbourne, unlike Sydney, has restricted, well, not restricted, but banned inspections of property. Sydney, you can still inspect property as a single person. And of course, with unable to view properties in Melbourne, you know, obviously puts that pause button on the market again. But once we get past the withdrawal numbers, which, as I said, were very, very high in Melbourne, we can still see that properties that got through that weren't withdrawn are finding buyers. And interestingly enough, in Sydney, I think that Sydney had another 80% clearance rate. Quite, I guess, incredible that we've had Sydney record 80% clearance rates every weekend through August. And August was a full lockdown period, of course, in Sydney. So it's still got plenty of buyer activity there. And in fact, seller numbers were up in Sydney. There was a rise in the number of auctions. So I think we found our base in Sydney in terms of the number of auctions. Yes, they're well down on the pre-lockdown periods, but the market is still turning over in Sydney and really no sign of any significant price declines as well. So listing numbers looks like found their platform in Sydney. And in Melbourne, it's just a question of really getting it through lockdown. And I believe there's some very strong lobbying going on at the moment in Melbourne to try to get the state government to agree to those limited inspection models that Sydney has, just to keep the market ticking over and not just sort of put it into the deep freeze until lockdown is ended. But the other capitals are turning over quite nicely. A big clearance rate in Brisbane, Michael, over 80%, very strong market. Auction numbers in Brisbane are also quite high, as they were in Adelaide. So really no sign of a transition into anything other than what is still a very much a seller's market across the board.
Well, it's the end of the month or the beginning of the month, depending upon when people are watching this. And so you keep a daily track of house prices, aggregate them at the end of the month. And so, as we're seeing on the screen now, the house prices have not grown as much as the previous couple of months, but other than in Perth, they're really doing very well. They're at levels that no one would have thought would have occurred a year ago.
Well, I think the point to this is, Michael, that we were already seeing a decline in prices growth, and it's sort of gone from white hot to red hot. So numbers are still very strong, and we're seeing prices growth still over 1% on a month by month basis. In fact, closer to 2%. So obviously, if we multiply that by 12, it's still a very strong result. But we have eased, even prior to lockdown, we were starting to ease over July in terms of growth rates. And that's continued. And obviously, the lockdown markets, Melbourne and Sydney, even though we've said that they're still transacting, are obviously transacting off a lower base. And that can typically mean fewer higher priced properties in the market. Those people have more choices in terms of postponing their buying and selling decisions. But still, numbers are quite positive and certainly in favour of sellers, and showing that there's still strong competition for available properties out there. But the trend is declining, and no surprise there. The only surprise, I guess, that we've seen emerge over recent months, Michael, is the Perth market has certainly flattened out, which is quite interesting, because the Perth market still has, in terms of relative affordability, the strongest position. Its prices are still below where they were in 2014. Yeah, some interesting results coming out of Perth. It's certainly flattened over the last couple of months, and perhaps there's something there in terms of the almost unprecedented new home building boom that's happening in Perth. Perhaps that's pushing median prices down, because we're seeing a higher proportion of new houses coming into the market versus established houses. But nonetheless, regardless of the underlying reasons, that Perth market is certainly not travelling as quickly as, in terms of prices growth, as the other capital cities. And I think the other point to make, Michael, is that the Brisbane market prices in Brisbane are now growing faster than any of the other capital city markets. And of course, Brisbane hasn't had the same degree of lockdown issues that Sydney and Melbourne have had. But we've also discussed the very positive drivers, particularly migration shifts that are activating and fertilising that Brisbane market at the moment. And we're seeing some results in terms of price growth coming through now.
So it's nothing to do with COVID, because those which have got COVID, more COVID cases, are still performing well, and Perth has been spared of that. So there's lots of factors driving our property markets, including supply and demand. So I know one of the areas that you look at is new listings coming onto the market, how they compare with the number of sales, which gives us an indication of how long it takes to sell properties, how much vendors have to discount. Overall, there's fewer properties coming onto the market than are selling at the moment, Andrew.
Yeah, well, look, no surprise with lockdown, Michael. We shouldn't be sort of reading too much into the impact of lockdown, other than the fact that it is, I guess we should say, more of a nuisance and a roadblock to property market activity. But we've seen, of course, a falling away of new listings. The physical restrictions obviously are a disincentive for people putting their properties onto the market. And of course, sellers have more skin in the game as well, Michael. So they're more likely to say, no, let's just wait until this sort of eases. Whereas buyers can still find something that they're interested in and are prepared to secure that. But we have seen a fall in national new listings, of course. But the interesting thing over the last week or two, Michael, is we're starting to see that flatten out. that I think we've reached the trough of decline in new listings growth, which I think is quite interesting. And we sort of discussed that to some degree with the Sydney auction numbers on the weekend, which actually showed an increase from the previous weekend. So I think we've sort of found our floor in terms of the decline in new listings. And if we look at that compared to the year before, so I also track comparisons with the same week last year, we can see that that's also now starting to rise after having dipped down close to where it was a year ago. So again, on those year-on-year comparisons, the market is lifting in terms of new listings. But we have to remember that a year ago, Michael, the Melbourne market was entering into a very lengthy shutdown period, and that had an impact on overall listing numbers. If we look at the performance over the last week, just validating the consolidation of the fall in new listing activity, where we saw new listings rise everywhere except in Perth, as we've discussed. So it is about having a steep collapse, finding a bit of a floor now, and that's as the market, the buyers and sellers adapt to the new environment or the changed environment. And as you alluded to in your introduction, Michael, people are a little bit more used to this environment now. They realise it's an impediment rather than perhaps something in terms of the housing market that has more long-term consequences. But when we looked at the relative position of new listings on a capital city by capital city basis, Michael, we can see that there's been a very big decline in the relative position of Melbourne and Sydney. And I think that really does tell the story in terms of the severity of the lockdown, Melbourne versus Sydney, and its impact on the housing market. We now have nearly 60% fewer new listings coming through in Melbourne compared to Sydney. And prior to lockdown, that was quite an even proportion. Sydney and Melbourne had about the same numbers of new listings coming through. Also with new sales, we're seeing a similar trend with new sales, Michael. New sales haven't declined at the same rate nationally as new listings, and that's why we're continuing to see positive price outcomes. And similarly, we're also seeing a little bit of a flattening of the decline in new sales, as we've been seeing in new listings. And no surprise that new sales in Melbourne are down the most over the past week. Sydney also down. And again, on that comparative position, Melbourne versus Sydney particularly, you can see that Melbourne new sales are 40% fewer than Sydney sales. And just a month ago, they were around about the same level. Now, we spoke about affordability when we looked at those house prices, Michael, and about affordability issues in Perth, which is positive. But I've also got up there my latest June quarter affordability index. And that really does show us why we started to see, if we remember, of the price changes, a decline in prices growth over from June to July. And of course, we've now seen another one from July to August, those monthly growth figures. And of course, that's exacerbated to some degree by lockdowns in Melbourne and Sydney. But nonetheless, we can see that affordability has declined. And on the index, the higher the index, the lower the affordability, because this measures the proportion of the average wage from the average loan that the repayment is. So as your repayment becomes a higher proportion of your income, obviously it becomes less affordable. The index shows declining affordability now. The National Affordability Index has now reached the average level. And I track that against house prices, and you can see how it's quite a reliable indication of changes in house prices as affordability declines. We've had a period of strong affordability since 2016, below average unaffordability, I guess you could say, above average affordability. And of course, we know in that period, we've had very strong prices growth. And that's because affordability has been positive. People have been able to pay more out of their incomes for higher prices, and it hasn't affected their affordability capacity in terms of the proportion of their income that they're paying their loan off. So, and of course, this is what we're seeing now. As affordability declines, Michael, we're seeing an easing in prices growth. And that's the trend we've clearly seen over recent years. And no surprise when we look at which capitals had the biggest change, or which states had the biggest change over the June quarter. It's the fast growing, the booming markets of Victoria and New South Wales, which of course reflects Sydney and Melbourne, and they had the biggest changes in affordability. And when we look at relative affordability, which compares the affordability of each of the states, no surprise that Sydney is well ahead of everyone else, and it's 17% higher. Its unaffordability higher than the national position set at 100. So affordability tells us what's happening, Michael, in terms of the housing market. As affordability is high, People will purchase more because they can pay more. And as affordability falls, it means buyers are constrained. They can't match higher prices because they can't borrow more because they don't have either higher incomes or a lower interest rate. We know both those factors are steady and likely to remain steady. So just a signalling, which I think is very positive, that the market is easing as we gradually see affordability decline from what has been a lengthy period of high affordability, which has enabled the market to push into high levels. But it's really, as we've discussed, all a matter of catch up. And everybody's catching up except Perth for some reason. So we wait and see how that one pans out.
Well, these are obviously national figures and state-based figures, but one has to look more granularly. So affordability differs depending upon what your income is. And clearly, while average Australians' income isn't going up, the knowledge workers, those who can still work from home, those where it doesn't matter where they reside and they can work over Zoom, their incomes are still doing well. The rich are getting richer. So it looks like while overall property values won't grow as fast, we're not suggesting property values are going to drop. Some areas are still going to outperform others, aren't they?
Yeah, absolutely. And that's what we're seeing in Queensland, Michael. Your point is spot on, because we're seeing an area which has a high relative affordability compared to Melbourne and Sydney. And we're talking Brisbane, where median prices are still half of what they are in Sydney and well below what they are in Melbourne. And we are getting that almost a flood of migration into southeast Queensland. So cashed up Melbourne and Sydney buyers can certainly afford to pay more because the actual property is lower. And that's, once again, as you suggested, a differential on the local market basis, which means that affordability in terms of a relative sense of prices is still very positive in Brisbane. But local Brisbaneites are having to pay more for their properties because prices are rising, and that's what will happen. And they don't have the benefit of higher incomes or a bigger deposit, which is what's coming in from southern states, or a lower interest rate. And even with high incomes, we are still constrained generally by the fact that interest rates, although of course very low, haven't moved for a year and are unlikely to go anywhere as well. So you can't get that lower interest rate drive, which is very important in the capacity to pay more, fertilising those housing markets going forward. But it's at this stage, even with COVID, it's an orderly adjustment from unsustainable prices growth, and certainly 25% per year, Michael, is not something without a massive inflationary sort of outbreak driving it, is not something that was going to last any more than a year, and that's what we're seeing now. However, the shutdown from COVID will only elongate the cycle, particularly in Melbourne, because once those restrictions are lifted, that Melbourne market, which still has plenty of demand for property, it'll be off and running again. We saw exactly the same thing last year, and Melbourne's really been catching up until, and once again, unfortunately, it's moved back into shutdown.
Well, at the beginning of this cycle, regional Australia outperformed capital cities, and then capital cities started to grow, and often from the lower price points, but now the higher price points within each of the capital cities seems to be performing well, again, related to the affordability. The affordability constraints don't seem to be as strong in the high end, the higher quintiles of our property market.
Yeah, well, that's right, Michael. And of course, we're seeing fewer first home buyers in the market as well. And they gravitate obviously to the lower end of the market. And affordability obviously is a bigger issue with first home buyers because they don't have the trade-in capacity to keep up with the market per se if they're selling their house and then buying another one, which owner occupiers typically do. So they're always affected firstly by higher prices and strong prices growth. We're seeing that. And of course, we still don't have the numerous incentives that were also driving first home buyer activity. But first home buyer activity is still high in a relative sense. It's just falling. But of course, the mantle has now been taken up by investors who are really active in the market at the moment, although still have plenty of upside to get back to average levels, investor activity.
So as I said at the beginning, despite the lockdowns, despite the concerns, we've learned to live with COVID. We've learned to transact properties differently, well, other than Melbourne, where it's really hard to transact at all. So we'll be back again next week because there's some interesting news coming out that's going to give us some insights into what's ahead, Andrew.
Yeah, that's right, Michael. And we're moving forward and adapting and surviving, I guess, in property. But once again, we know that there is no integral impacts, short to medium term anyway, on property markets. Obviously, the longer lockdown goes, it starts to impact the economy. But this time we're coming from actually a much stronger position in terms of our economy with that low unemployment rate. And even though we had a decline in participation in New South Wales, which did impact the employment rate, in other words, it pushed it down a little lower, it would have still been well and truly a 4% something unemployment rate regardless of that. So we are coming from a stronger position in terms of our economy, but we've just got to really get out of lockdown as soon as we can, Michael.
That would be nice, wouldn't it? Catch up with you next week. Thanks, Andrew.
Bye.